Good morning to you all, good afternoon, and good evening as well. It's a pleasure and an honor for us all here to receive Professor Dr. Joachim English from the University of Münster to join us here in this last stage or round of our discussions regarding the tax regulation of the digital economy. And today, as planned, we are going to talk with Professor English about these tax challenges arising from the digital economy at the international level. First of all, I must thank here all my graduate students who have already joined us, our colleagues here as well, our colleagues in Europe and in the United States who are joining us here with this great discussion we are just going to have in a few minutes. And I must confess that it's also quite a little bit strange here to have this discussion or this debate with my dear Professor Joachim English, since we have some kind of lived together in Germany for almost 4 years, and on that time we have spoken the whole time in German, and I think it's a little bit strange, but I think we can handle this challenge today. And so I must thank Professor English for your time and your disposal to join us here with these discussions at the highest possible level. And it's a great pleasure and a great honor to receive you here today, Professor English, as a colleague now, and also as a friend, and someone who has joined me in a very important stage of my life in Germany from 2009 and 2013. And I wish to thank you as well from my family back home, also in Porto Alegre, for your presence here today. And I would like to introduce you to our colleagues here in Brazil and to my graduate students. Professor English is professor at the University of Münster in Germany, and he had also a professorship 2 years ago at the Sciences Po in Paris, when he worked very close to the OECD tax advisors, joining them with the tax challenges of the digital economy. And today it's a great honor and a pleasure to have you here, Professor English, to see your perspective and your point of view about all these tax challenges arising from the digitalization of the economy, and also the challenges arising from the VAT reform also in Brazil. You have noticed, of course, that we are discussing nowadays, and for the last 2 years, maybe at least, our VAT reform here in Brazil. And we have in front of us, for the last 2-3 years, all these discussions, about a possible implementation of some kind of European, maybe some kind of European VAT here in Brazil. And then maybe at the end of the presentation today, we'd like to listen to you as well about these ideas, these discussions here in Brazil. But Professor English, feel free to join us, feel comfortable here, as it was in your home here, okay? And I'm really looking forward to see your presentation. First of all, before I forget, I must do the usual disclaimer here from our institution, and regarding that all statements expressed by the Fundação Getúlio Vargas employees and guests in our online events and broadcasts exclusively represent their opinions and not necessarily FGV's institutional position. We also reiterate that everyone present here agreed to participate in this event of their own free will, and they consented to be recorded in this broadcast, which will be posted later on FGV's official channels. Then, my dear friend Joachim, feel free to join us and make your presentation. Thank you very much once again to be here with us.
Dear Professor Fossati, mein lieber Freund Gustavo, many thanks for this very warm welcome and introduction. I myself feel honored to have been invited in this lecture series to speak today about the latest developments that we have on the taxation of the digitalized economy at the level of the OECD inclusive framework. And as you said in the discussion after the presentation, I will also be very happy to comment on possible EU reactions, as well as VAT as a complementary way of adding the efforts to effectively tax digitalized economy and actually to bolster revenues even beyond digitalized economy. So what is it that I will try to talk about today? Well, as you will all know, there is since years a discussion going on at the international level, not only at the OECD, also at the UN, but today I will focus at the OECD discussion because this is where the relevant standard setting will occur, if it will occur at all, as to how the digitalized taxation could be more effectively taxed internationally. Also, already when the BEPS project of the OECD began in 2013, there was a widespread feeling that current international tax system, which is basically still looking like it looked 100 years ago, is outdated when it comes to the digitalized economy, is not fit anymore to the specific features of the digitalized economy, like virtual presences, scale without mass, ability to concentrate functions offshore, and so on. And so one of the 15 actions of the BEPS action program was actually devoted to the digitalized economy. However, by 2015, it became clear that no global agreement would be evolving on this issue, in particular because the US at the time, under the Obama administration, remarkably blocked any efforts because they feared that their digitalized champions would be taxed in other countries, and the US would get nothing in return. And so basically, when the dust settled after BEPS, an inclusive framework was set up, which invited countries from all over the world, beyond the 44 countries that had participated in the BEPS project, to implement BEPS and to maybe think in the coming years also about solutions for the digitalized economy. Not that anybody expected so much from that. But then two things happened. First of all, many countries were dissatisfied with the outcome of BEPS Action 1, the compromise not to suggest anything on the digitalized economy, and they moved forward with unilateral solutions. So India was here a pioneer with a digitalized services tax, but also introducing sort of a virtual PE, a taxable digitalized presence. And then others followed suit, including many European countries and even the EU Commission with a proposal which so far has not been adopted, but it was out there. And so some pressure built up to really find an international solution to avoid this, if you like, uncoordinated spreading of unilateral solutions, which of course imply the danger of double taxation and trade barriers, and also to avoid a trade war then with the US administration. And then the real game changer was, of course, the 2018 US tax reform, which under the Trump administration now, pushed by some prominent congressional US Republicans, much more aimed for actually taxation at the market. So you remember all probably the 2017 debate on the Ryan blueprint and introducing a destination-based cash flow tax, which in the end didn't make it. But the idea was born that it might actually be a good thing to move more towards taxation at the market, something that the Obama administration had violently opposed before that. And plus, the US also introduced some form of minimum taxation. The GILTI and the BEAT rules were introduced. And all of a sudden, the playing field looked very differently. And countries decided, G20 countries decided that the OECD should speed up its efforts to come up with a solution for the digitalized economy, and to deliver an early interim report, which we saw in 2018, and to actually come up with a solution until 2020, which would be now. As you will probably also know, the discussion, the negotiations in the inclusive framework of the OECD, which was tasked with carrying out this effort, quite early focused on two pillars. So it was split in two pillars. One was actually dealing or trying to deal with solutions, how to allow market jurisdictions to tax a larger share of the profits of large multinationals that relied on digitalized features in their business models. And then a second pillar was set up upon a French-German, rather German than French initiative, which is to introduce an international effective minimum tax. Actually, I should maybe give you some background on this. The Germans liked the idea because they hoped that by having a minimum tax, they could deflect a little bit from the efforts to tax more of global profits at source, so in the market, because as you know, Germany is one of the world's leading exporters, and so the German government was a bit, unhappy with this trend, more taxing rights for source countries. So they tried to deflect from that, and what then happened at the OECD level is, well, it was picked up, but the other efforts were not slowed down. Instead, a two-pillar approach was chosen. So pillar one still dedicated at measures trying to move more taxing rights towards market jurisdictions, and another pillar that was devoted to the idea of effective minimum taxation. And this is why we have pillars 1 and 2 in the OECD work ever since late 2018, early 2019. A lot of work has been invested. We still don't have an agreement by 2020. Why not? Basically for two reasons. First of all, as we all know, there was the COVID pandemic, which considerably slowed down negotiations because when it comes to the negotiations among the now almost 140 countries in the inclusive framework, with very, very different political interests, policy approaches, economic backgrounds. To find and strike a compromise, it's essential, that you have those meetings in the margin, that you, can personally negotiate in maybe the evening hours and things like that. And this is all not possible, obviously, via WebEx and other virtual meetings. So this slowed down efforts. And second, and maybe even more importantly, the Trump administration, maybe not so surprisingly, took another U-turn, as they have taken so many, and they decided they would only want a reallocation of taxing rights towards the market on an optional basis, optional for the businesses, that is to say, and everybody else was quite unhappy with this, and so the talks are now politically at the moment at a dead end, and we will see how the Biden administration will maybe revive them. So, which is why in October this year, instead of a final agreement of those 140 countries, we got a blueprint, so a draft on how a compromise might likely be looking like. And it is actually this draft, and I will now also then start with my slides. It is this draft that I will discuss with you. Of course, obviously, these drafts, a few of them, or maybe many of them, I don't know how much you're into this, might have read them, but it's altogether some 500 pages that you have to read. And it's obvious that I can't cover every detail of those drafts in my presentation. So what I'll do now in the remaining 45 minutes or so is that I will give you an overview. I will give you a feeling of the current state of affairs, of the key pressure points, of the key political decisions still to be taken, of the broad design issues of both instruments, so the reallocation mechanism, which is pillar 1, together with some add-on features, which we also find in pillar 1, especially concerning international administrative assistance, and the minimum taxation, which is pillar 2. And I hope it will be a critical analysis. It won't merely be reproducing those 500 pages, which might be a bit boring. Nevertheless, it might be a bit more technical on the Pillar 2 side, which is basically due to the fact that negotiations on Pillar 2 are much more advanced because most political differences there have been resolved, whereas a Pillar 1 reallocation of taxing rights is much more disputed, still politically, not the least, as I've said, due to fundamental US opposition to any solution binding also upon the businesses. Okay, having said this, let's then start with discussing the current state of affairs, the blueprints as they have been published this October. And those blueprints, I should also mention, will now form the basis, first of all, for a public consultation where the deadline ends next month. So everybody is free to submit position, comments, suggestions on those blueprints. And then from that on, the inclusive framework and its steering group will try to find a solution, hammer out a compromise by mid-2021, which is just half a year from now. So very ambitious. We'll see whether that works out. Certainly, this will, to not a small extent, depend on a possible US leadership role under the Biden administration. Okay, if we have a look first then at Pillar 1, so the effort to reallocate taxing rights more towards market jurisdiction, more towards jurisdictions where users are located, rather than to other jurisdictions where often intermediate holdings are resident in so-called investment hubs, so basically low-tax jurisdictions which suck up all the profits. So to have a more balanced allocation to give more taxing rights to those countries where those businesses that are active in the digitalized economy actually have their users or consumers. And as an add-on, there is also some idea to have a simplified approach towards transfer pricing regarding certain activities, which is the amount B. And finally, to come up with some ideas for a binding dispute resolution mechanism. The OECD is very keen on avoiding the bad word arbitration, but it boils down to this arbitration mechanisms for especially now this reallocation idea under Pillar 1, but also beyond that. And we'll have a look at all of this. And afterwards, as I said, we will then also address Pillar 2. Okay, this is more or less an official graph from the OECD, except for the light blue at the bottom, which is the US alternative to all of this. And as you can see, Pillar 1 is really broken down in 3 initiatives. The largest one, actually, also where not only in terms of pages, but the most ambitious one is to change the allocation rules as we currently find them under international tax law, so especially the OECD and the UN models, with in particular the OECD model basically giving taxing rights over business profits only if there is a physical presence of the business in the respective country. So either a company which is resident there, or a PE, a permanent establishment. And absent such presence, normally no taxing rights can be claimed regarding business profits. As we know, the UN model is a bit more generous with source countries, contemplates certain withholding taxes. However, often you do not find them in tax treaties, especially not in tax treaties between developing and emerging countries on the one hand and more industrialized countries on the other hand. So the status quo is really that often, normally, you can tax those business profits only if there's a physical presence. And even if there is a physical presence, maybe not much of them if in this physical presence, for example, in the PE or in a subsidiary, only routine activities occur, because under the current arm's length pricing rules, most of the profit goes to, as we all know, where the intangibles are, the valuable intangibles are, where the risks are taken, and where the related functions are performed. And this is more often than not a low-tax jurisdiction or a so-called investment hub. So to change this, we have this Amount A initiative, and then we have Amount B, which is concerned with simplifying transfer pricing for selected transactions, and then we have this tax certainty sub-pillar. And all of this, according to the US perception, should be something businesses can choose, but need not to do. And this is what everybody else opposes, basically saying, well, if it's optional for businesses, then we might have 3 businesses globally opting for this, and all the effort is in vain. But I'll come back to this later. So this is what we're going to discuss, basically. And I'll start with the amount A, which is the most relevant of these sub-initiatives, if you like. Okay, what's the idea here? Well, basically, the main idea is to allow market jurisdictions, including jurisdictions where users of digitalized services are, so users of social media such as Facebook, users of search engines such as Google, and so forth and so forth. So where users are, where markets are, this is where taxation should occur to some extent, different from what we find now, where we need a physical presence to allow for taxation, and where again, the physical presence will only get to tax, or the physical presence jurisdiction will only get to tax profits that have been earned through the physical presence. Okay, however, this is then limited to highly profitable, as we shall see, digitalized multinational business models. So it's not going to concern all business, it's only going to concern very large multinationals, and a few words on the technical details in a few minutes. And also only if they are highly profitable, so if they have a very significant return on sales. So profitability, as we shall see, is measured by profits before tax as compared to revenues. And those businesses will then have to allocate some of their profits to the market jurisdictions for taxation purposes. Now, what's really the new thing about Amount A? Well, one I already mentioned. It would lead to taxing rights without the need for a physical nexus. So you would have a sort of virtual presence, which is sufficient, a virtual connecting factor, which would be sufficient for claiming taxing rights. And second, we would have some departure from the arm's length principle, because the amount of profits to be allocated to this virtual nexus would not be determined by way of arm's length standard, which is, of course, natural. You couldn't do it. I mean, there is no assets, there is no functions performed in a virtual nexus. Instead, you will have a formulary apportionment of profits to this nexus. And so this is a big, conceptually quite revolutionary step for the OECD in particular, to abandon the arm's length principle cherished since about 100 years and to go for formulary apportionment in some area of profit allocation. Well, of course, from an academic perspective, you can complain, and I do complain to some extent, but I know it's an academic perspective, that we do not really have a very principled approach when it comes to this Amount A. The reason for this is that on Pillar 1, there were three competing ideas in the inclusive framework of those 140 countries. There was one suggestion by especially European countries to just go for the highly digitalized business models, the GAFA, so basically automated services delivered through the internet, which is like Amazon, Google, Facebook, and so forth. Quite obviously, this is so because from the perspective of those highly digitalized services, Europe is actually a developing country. So we're importing those services a lot. We're not exporting so much of them. It's China and the US that are exporting these services. So those European countries thought, what a great thing. Wouldn't it be great to be able to tax this part of the pie, but not tax anything beyond where we're the actual exporters, and that's not give too much to source countries. Then we have an intermediate proposal of the US, or we had one. The US said, that's too narrow because basically it's going to damage only us and we're not going to gain anything. So we should also include basically companies that exploit marketing intangibles in the market country, in the market jurisdiction, valuable marketing intangibles. And where that's the case, the market jurisdiction should to get part of the pie, should to be able to tax some of the profits. And this goes beyond highly digitalized businesses. The economy is digitalizing anyways. We can't ring fence the application of this approach towards highly digitalized businesses. That was the US position. We should be more broad. Of course, bearing in mind that the US has a huge trade deficit, so by being able to tax more in the market, they might actually, in the short run at least, benefit fiscally. And then we had the G24 proposal, so a group of developing and emerging economies saying, well, we need something simple and we need something that gives much more taxing rights to the market. And so we should have a broad formula according to which a certain percentage, 30% maybe, of profits should just go where sales are, quite simply. And then the OECD Secretariat tried to strike a compromise between those three competing visions of what to achieve under Pillar 1. And we got the so-called unified approach, which is still underlying the Amount A concept. And it might not surprise you so much that the EU and US proposals dominate a bit more than the developing countries' proposal, even though theoretically each country has the same vote and voice in the inclusive framework, but de facto, yeah, we still have a certain preponderance of the OECD membership, actually, which is the club of more or less rich countries. And so, yeah, we have this mix, what I call an eclectic mix of different concepts, but especially we have a mix between this smaller, highly digitalized company approach and the broader marketing intangible approach of the US. And then we have a few elements of the proposal of the group of developing countries. And so it's not that we can say, it follows one overarching principle. No, some aspects follow more this principle, as we shall see. Some others follow the other principles. Okay, as I said, there's a lot of political negotiation still needed to come to an actual solution under Pillar 1, much more than under Pillar 2, as we shall see. What's still open is still, in particular, the scope of Amount A. So what should be covered? What kind of services, what kind of businesses should be covered? Should we go for smaller M&Es or just for the very large ones, and so forth? And what's also totally open still is the reallocation formula. So how should we calculate the part of profits that will eventually be reallocated to market jurisdictions? And of course, that is highly politicized because it determines how much basically the US and to some extent China and a few others will lose, and how much the rest of the world will gain in terms of revenue. And the second thing I already mentioned, we also do have those political issues still to quite some extent in Pillar 1, because the US has insisted since this summer on a safe harbor concept, which everybody else more or less dislikes. Okay, so this was a very broad overview of what Amount A is trying to achieve, of the underlying political tensions, and what the inclusive framework has actually made of it. So sort of a compromise, which boasts especially those innovative features that I just mentioned. No physical nexus needed anymore, a departure from the arm's length principle. Now, if we have a bit closer look at some of the details, how would this work? I guess I'll go through this rather briefly for the sake of time, and I think if there's questions, we can then discuss that after the presentation. So first of all, you'd have to find out whether the multinational that could be subject to the Amount A reallocation is actually large enough, so there will be threshold tests, is also engaged in any activities that come within the scope of the Amount A reallocation. And under the current blueprint, the two types of activities that would be in scope is automated digital services. So basically highly automated services that are delivered via the internet, the GAFA thing, plus a bit more like cloud computing and so on. And this is a nod towards the US marketing intangible thing, the consumer-facing businesses. So any businesses producing consumer goods or retailing them directly to consumers would also be covered by Amount A. But only, again, if we're talking about large multinationals. So the idea is to align the threshold at least with country by country reporting threshold that would be 750 million euro global turnover. And the discussion is whether the threshold might need to be set much higher. I'll come back to this later on. Once we have an M&E, a multinational that comes within the scope, the personal and substantial scope of the amount A, and we're talking about, depends on where the thresholds are set, a few hundred or a few thousand multinationals, not more. Then they will have to determine whether they have actual excess profits, because under the predominant view in the inclusive framework, only so-called excess profits should be reallocated, stemming from these ADS or CFB activities. And that means we first have to see, okay, how much profits does the group earn with those kind of activities? And then how do these profits relate to the revenues of this firm? Because excess profits, as I said, is determined as profits before tax as related to revenues. And here, of course, the first very political issue arises. What is the way to determine these excess profits? Now, interestingly, technically, this will not be done on the basis of tax accounting because it would be too diverse globally. It will be done on the basis of consolidated group financial accounts. They will serve as the basis with certain adjustments. And this is then how profits are determined. And these kind of profits will then be related to the revenues. Again, a problem arises. When do we have excess profits? So a percentage needs to be applied. Is it if you have more than 5% profits related to your revenues, or is it 10, or is it 15? And of course, the higher you set the threshold, the less will be reallocated under amount A. And currently, the most realistic outcome is 10%, as far as I can see in the negotiations. So 10%, if the profitability of the firm is more than 10% of its revenues, then it will be actually subject to reallocation. If it's less, it will not be subject to reallocation. And that takes out a lot of firms that are not so highly profitable. It takes out around 70-80% of firms, of course, depending on where you set the threshold. Okay, if we have those excess profits, they will be reallocated to the market or user jurisdiction. Now, for that purpose, you have to know where the market or user jurisdiction is. And that means you have to identify those countries which have a sufficient nexus as market or user jurisdiction. And this will be done basically by relying on sales, whether a certain sales threshold is surpassed in the relevant jurisdiction. And for consumer-facing businesses, some additional requirements might be set up. There is no agreement on that yet. Now, that means you need to know whether sales do occur so that you can allocate sales to a particular country and see whether the sales allocated to this country are above the threshold that gives the country nexus to claim a portion of the excess profits. And for this purpose, there will be sourcing rules which will determine whether the revenue from a certain kind of automated digital service transaction or a certain kind of consumer-facing business activity is actually sourced in a particular jurisdiction. And maybe not so surprisingly, this follows to some extent a VAT logic, because we face the same problems under VAT. We need to source transactions for VAT purposes, and more or less the same sourcing rules can then also be used for this exercise. Once we know where the amount A should go to, so the excess profit share should go to, we need to do another calculation, because not all of the excess profits will go to the market. The reasoning here being, well, a lot of excess profit is also due to trade intangibles. So in innovation, inventions, trade know-how, a workforce, and so forth. And only to some extent does the market contribute to those excess profits. And so again, we have a political issue. How much of this excess should then actually go to the market? And as far as I can see, we might be ending up, if we get a compromise at all, with 15-20%. So of the portion that is above 10% profitability, only 15 to 20% might then go to the market. And this then, and this is the last step on the point 3, needs to be allocated amongst the different countries, and this again will be done based on a formula, basically relying on their share in the overall sales. So here again, you need the sourcing rules. Say if there's 2 countries, A and B, one has a share of 30% in overall sales and the other in 70%, then B will get 70% of the revenues to tax, and A will only get 30%. That's the basic idea. And then, of course, we still need to avoid double taxation. This is the great advantage conceptually over the digital services taxes that we now see spreading. This would be internationally coordinated, so we should not have any double taxation. The second difference, by the way, being that this would be more or less net taxation, whereas digital services taxes are gross taxation. And so there need to be rules on which country then needs to credit the amount of profit that has been taxed at the market, or the tax of the market jurisdiction rather, or needs to exempt the profit that has already been taxed at the market. And this is a rather complicated process under the current blueprint. Essentially, the basic idea is those entities within the group that have significant intangibles and are in some way involved in the retail or delivery of the service or goods in the market should bear the burden of having to credit the market jurisdiction tax or exempting this profit that has already been taxed in the market. So, but that's how it would basically work. Do we have a qualifying taxpayer? If so, is this taxpayer profitable enough? If so, how much will be allocated to the market jurisdictions, and how do we determine which is a qualifying market jurisdiction? And finally, we need to resolve on the international double taxation issue. Now, I could give you some more details on the individual steps, which is what I have here on those next slides. But I think considering the time constraints that we have, we might want to go through that maybe in the discussion of individual aspects. And most of the most relevant aspects I already just mentioned. So here you could find some more details on the individual steps. Basically, yeah. As you look at it in more detail, you realize how complex many of those rules actually are. So it's by no way a simple thing. And obviously, it requires a lot of international collaboration because you need to agree, if you really want to avoid international double taxation, on, well, how much are the revenues, for example, in each jurisdiction, so as to coordinate the allocation of amount A amongst the maybe 50 jurisdictions that have a qualifying nexus and so forth. How much is the profit that can actually be relocated? If you want to avoid double taxation with this respect, this needs to be internationally coordinated, much more than traditional transfer pricing, which still is, to a large extent, a bilateral exercise. Okay, how would all of this be implemented? Well, first of all, domestic taxing rights in the individual countries would have to be created to be able to tax this amount A, even though there is no physical presence. Then bilateral treaties, which still require such a physical presence, would have to be amended. This could be done bilaterally, but it would probably take forever. Or we could see, this is the idea of the OECD or of the majority of the membership of the inclusive framework, we could see a new multilateral convention, similar to the multilateral instrument that we have to implement the BEPS 1 outcome. We would see another multilateral instrument to implement this BEPS 2 outcome. And we would basically have a new taxing right for amount A, which would operate alongside the existing taxing rights in the existing treaties. And what this multilateral convention will also try to do is to ensure that even where there's currently no treaty, we would not have any double taxation regarding this amount A. And then very importantly, we also need procedural rules to actually collect this amount E and reallocate it to the several market jurisdictions. And this, according to OECD, and only this makes sense, would have to be centralized, usually in the country where the ultimate parent is located. So many times that would be the US, but sometimes maybe also China, India, and a few others. And they should be the ones with so those tax administrations should be the ones that the group, the multinational, has to deal with when it comes to the self-assessment, when it comes to audits, when it comes to an application for tax certainty processes, which I will discuss a little bit more in detail in a few minutes. And to have this at an international public law level, again, we probably need domestic implementation, especially authorization for such centralized processes. So this is how this would be implemented. Then amount B, I'll be very brief on this. Amount B is, sort of a compensation. I mean, maybe you got an impression, and we could go much more into detail, that amount A is going to be really complicated. And actually, according to my view, it might overwhelm tax authorities, especially, but not only, in emerging and developing countries. So the inclusive framework felt that some simplification should be offered in another respect. And so there is this idea to standardize transfer pricing outcomes for marketing and distribution routine functions in the source country, basically by relying on benchmark returns, benchmark figures for a transactional net margin method. So for a particular transfer pricing method, where you would normally look at the features of the individual case to determine an adequate market return on those routine activities. And here you would have a standardized approach. You would not look at the individual case, but rather you would take this standardized percentage, apply it to the relevant base under the transactional margin method, and then you would get your transfer price. Not everybody is so happy with this. There are some countries who strongly believe in transfer pricing, who say, well, it should only be rebuttable presumption. It should not be mandatory for businesses. But of course, if you do it this way, then the entire simplification effect, that tax administrations don't have to worry about, having to deal with all sorts of calculations and database arguments brought forward by the taxpayer to keep profits low. But rather they could rely on some more standardized approach. And if you make it a rebuttable presumption only, then of course the simplification effect is largely gone. And so I don't think and I don't hope that this will make it in the end as part of the compromise. This should be binding, the amount B, for anybody affected by it. Okay, and then very importantly, but also something that especially developing and emerging economies view very critically, is the intention of the OECD Secretariat and a large part of the Inclusive Framework membership to have more binding arbitration, to put it bluntly, for at least amount A. Because obviously, as I said, there is the need to coordinate amongst the several countries that could be affected by amount A. And if you don't do this, you will almost certainly have double taxation. Individual countries claiming they have a much higher share, according to their interpretation of the sourcing rules, of the overall revenues, and therefore they should also get more of amount A, or maybe claiming that profits as calculated under a group consolidation are actually higher, should be higher. So there should be more of an amount A to reallocate and so forth. So if you want to avoid this, and if you want to have also a working avoidance of double taxation in then the country that is responsible for this, so basically where the entities are, where the IP is located, you need to have a multilateral administrative approach. And this is what this third sub-pillar is about enhancing tax certainty. There is the idea to establish panels, review panels, so the multinational could in advance apply for an assessment, and then the panel would say, okay, this is fine with us, go ahead, and we will allocate taxes accordingly, so there's no overlap. And if they can't agree in this panel, which should be composed of selected members of those countries that are affected, so not everybody would be on the table, but only a few a representation of, there should be one developing country, there should be one small country, there should be the ultimate parent jurisdiction, and so forth. So it should be a representative panel made up for each individual case. And if they can't agree, there would be mandatory arbitration. Now, the point is, if you have, which is the estimate of the OECD, if you have a low threshold, and then you would have probably 1,000 businesses almost affected, 1,000 multinationals. You need 6 to 8 panel members for each case. That if you have different panel members, and they will have to do some work, you would need several thousand panel members from tax administrations all over the world. Where are they going to come from? How is that going to work? My guess is it wouldn't work. It would overwhelm tax administrations. So actually, it doesn't make sense to start so big, because you couldn't do this review process. But if you can't do the review process, it's going to be a huge mess. So we need to start smaller, and this might not be such a bad thing, because in my view, it could actually enable compromise. And I've tried to air this idea also with the OECD and a few country representatives in the inclusive framework that, that's the next slide already, before I come to the pros and cons, that this could actually, enable compromise between the US position and everybody else's position. That's the first bullet here. You could say, okay, it's a mandatory thing, the amount A reallocation, the tax certainty, the arbitration, and so forth, only for very, very large enterprises. You still would catch quite some revenue, a 5 billion or more. And this would only be a few hundred then. And for everybody else, it's optional. So a few would maybe opt in because they like the tax certainty features, but probably most would stay out. And then you start small. The US is happy because a lot is still optional, but effectively, you couldn't do much more anyways. So everybody else should be happy too as a start. And then after a few years, you revisit and see whether it works and whether you can expand. The US idea is, of course, that in exchange for the amount A, everybody else should abolish their digital services taxes. And this, whether this will happen or not, will be part of an overall package deal, obviously. And now it won't be so easy because, as we know, countries now need revenues badly due to the COVID-19 crisis. So the thing is, if we start small with the amount A, plus, the percentages will be as they currently look like they're going to be, so rather small reallocation effect. The OECD itself, in its economic impact assessment, estimates that not much, maybe some 10, 15 billion, even though that's a very rough estimate, will be reallocated globally. So that's a small extra pie to be shared amongst all those market jurisdictions. You wouldn't get so much out of it. And should you give up your DST for not getting so much out of that? Yeah, well, that's a question that will make it a bit more difficult to agree on this. Maybe on a temporary basis, I could imagine, as a goodwill towards the US, and then we would either expand that pretty rapidly, or if we can't, we would go back to the DSTs. I guess that's what happened. But anyways, everybody should be aware that if this were to become an international agreement, countries shouldn't expect so much revenue out of it. They will still need other revenue sources, in particular VAT, but maybe also, as we shall say, Pillar 2, the international minimum taxation. Now, I skipped this slide. Is it worth the effort at all? Because really the main point against is it will be highly complex, amount A at least, and most countries can expect very little in terms of extra revenue out of this, because only a few multinationals will be affected, several hundred maybe, but not more, even though they're large. Still, it's not such a big number, plus only quite little will be reallocated. Only the most profitable of those multinationals will be affected at all, and even their excess profits will only be reallocated to 15 or 20%. So in the end, it's not much in terms of revenue. So it's more, in my view, a first step thing. Yeah, you might still want to go for this because it is conceptually a big step, and many might say, and I would agree, in the right direction. Because we would get away in a first aspect from arm's length principle, which, with respect to intangibles, as we all know, doesn't really work very convincingly. Now we would get some formulary apportionment. We would we would depart from this ancient notion that there must be a physical presence. So market jurisdictions would get to tax, even though officially not because they're market jurisdictions, but because of some other thing. You know, there's users or there's a marketing intangible, but de facto, it would be a concession of taxing rights, an internationally agreed concession of taxing rights towards market jurisdictions. And we would have the inclusive framework set up as a permanent framework for international tax standard setting. And given the institutional weakness of the UN, it's just not realistic that the UN in the next 5, 10, or probably even 15 years will be the forum for international tax standard setting globally. So it might be a good idea to have a more inclusive forum at the OECD, which the inclusive framework could eventually evolve into. So it's much better than what we got in the past, I'd say, when it comes to global inclusiveness. And so I think from this perspective, yes, it could be worse taking a shot at it, even though revenue-wise, an international compromise won't allow much. Okay, that leaves us with very little time for Pillar 2. I personally find Pillar 2 quite intriguing. I devoted even more research to Pillar 2 than to Pillar 1. But yeah, for most people in the outside world, outside of this little home office I'm sitting in since months and months, Pillar 1 is a bit more exciting. So I think it's okay if I keep Pillar 2 a bit shorter and just do some conceptual overview, offer some critical analysis as regards the concept, and that shall be it. And we can go into technicalities if there's interest in the discussion. What's the idea? As I said, it's about the effective minimum taxation of large multinationals. Large meaning they should be above the country-by-country threshold, country-by-country reporting threshold of BEPS Action 14, so more than 750 million euro annual group revenues. And those companies, which is about, as OECD estimates before the COVID crisis, were between 8 and 10,000. Now it's probably going to be a bit less that reached this revenue threshold, because most, even not all, companies suffered during the crisis. So some maybe 7,000, 8,000 multinationals would be covered. And according to OECD estimates, that is equivalent to 90% of global corporate profits. So it would cover a lot of what's around in terms of global corporate profits, even though you limit it to several thousand companies, or groups actually of companies only. The idea would be to look at the effective tax burden of the multinational in a particular jurisdiction. So not globally, as the US GILTI does, if you are familiar with that maybe, but to look at the effective tax burden that a group profits that can be assigned or allocated to a particular jurisdiction have to bear. And if that's too low, if it's below an agreed minimum rate, then an additional top-up tax will kick in to be levied in other countries to bring the overall level of taxation up to the minimum that has been politically agreed. So far, this is the big political question that's still open. We don't have an agreement on the minimum rate. But if you follow political discussions, if you talk to members of the Inclusive Framework Steering Group, and if you look at the economic impact assessment, what are the figures they are calculating with, you can be pretty sure it will be not so high. It will be between 10% and 13%. That will be the minimum rate. However, bear in mind, it's going to be effective minimum rate. So it's not going to be nominal rates. Then it would be really too low. It will be effective rates. So anything, in terms of, offering loopholes in the base will also be covered by this. The difference between a traditional, CFC legislation, for example, would be that it's not limited to passive income. So it would really cover all kind of profits merely because they are taxed too low by the minimum tax standard. As a political compromise, however, which was not in the original concept, we now have a carve-out for routine profits of substance-based activities. So a lot of countries objected that, oh yeah, that's really too much on our tax sovereignty if you do that, because then we can't use tax anymore as an incentive to attract investment if there's minimum taxation, which is exactly the idea of the minimum tax. You shouldn't use tax excessively as an instrument to attract either book profits, so mere profit shifting, or investments. But several countries, especially of course, marginal countries which rely on tax as an incentive, but also of course the usual suspects, so Ireland, Singapore, and others, which basically offer low tax jurisdictions also to attract some investment. They said we need a carve out here. We should be able to compete based on taxation with other countries for investment. And so a carve-out was designed, but only for real investment, only for the routine return on tangible investment, which is what we already have, by the way, on the US GILTI, and a certain routine return on payroll, so the labor factor. And that means if you look at the numbers in the economic impact assessment, that only a very small portion, now depending on how you design the carve-out, which is still open, so it has not been fully agreed politically yet. But if you look at the economic impact assessment, you can see that only approximately 5% of the too low taxed profits that would be covered under the minimum tax would be carved out. Only 5%. The other 95% of too low taxed profits could still be taxed because they are excess profits resulting either from intangibles being taxed low or they are mere book profits that have been shifted into a low tax jurisdiction or into a tax haven. And so, it's really a superficial thing. It's been offered to those countries that insist we need to demonstrate to our electorate that we fought against, against an impingement and infringement of our tax sovereignty, but de facto it's not going to change much. It's still going to be an instrument not only against profit shifting, but also an instrument against international tax competition that is excessive, that goes beyond the minimum rate when it comes in particular to attracting research and development and the resulting intangibles to a particular jurisdiction. Okay, and the basic idea is that you look at those jurisdictional profits, how much tax is there. If it's too little, if the effective tax burden is too little in a particular jurisdiction on all the profits that can be allocated to this particular jurisdiction, then an extra tax will be collected. And this will be collected either in the ultimate parent jurisdiction, or at least a parent jurisdiction, by way of an income inclusion rule, sort of a CFC rule, or to the extent that it cannot be covered there, for example, because the parent jurisdiction does not participate in the initiative, does not adopt the minimum tax, then as a fallback rule, this additional tax can be levied in the source countries where the payments come from that are then converted into low taxed income at the recipient of the payment within the group. So that is a priority that at first sight is just a technical thing, which is easier to implement. Well, the income inclusion is easier because you start at the top, and the top usually has all the information needed to see where the additional tax should be levied. Or if that doesn't work, you go to the source. But of course, this has also certain revenue implication, because the top means this is where the top holding entity is. And so that means that holding locations, the classical holding locations, the US, Singapore, Japan, maybe to some extent European countries such as Germany and France, will get a lot of the revenue coming from globe. Whereas typical source countries that don't have many global players headquarters there will not get so much, because the taxation in the source country under the undertaxed payment rule is a subsidiary or fallback thing only. And this is, of course, mostly true for emerging and developing countries, which is why, as a compromise, the blueprint now considers that the first priority should actually not go to an income inclusion rule, so sort of a CFC rule, but the first priority should be with a subject to tax rule, sort of a minimum withholding tax on certain payments. So if certain payments prone to BEPS, such as royalty and interest payments in particular, are taxed too low at the hands of the recipient, the country where those payments come from, these intercompany, these intergroup payments, will be allowed to levy a withholding tax to bring the overall tax up to the minimum level. And only after that will the other rules kick in, so the income inclusion and the ultimate tax, the undertax payment rule. So the first priority would be with those source countries where certain payments are flow to other countries, not taxed too low there under a simplified approach. And this is a nod towards the needs of both revenue-wise and administrative capacity-wise, developing in emerging countries in particular. And then the actual more accurate, but also more complex minimum taxation that looks for effective tax rates of the entire group would then primarily occur in the ultimate parent jurisdiction of the group under this income inclusion rule. Again, we could discuss a lot of technicalities of this. The scope, as I said, several thousand companies, probably 90% of global profits. We could discuss how the effective tax rate is actually calculated. The main point to take home here is what you find in red. Like Pillar 1, it's not going to be based on tax accounting standards because they would be too divergent globally. You need a more streamlined approach, so it's going to rely on international financial accounting standards for consolidated group accounting based either on IFRS or similar equivalent standards. And then there is a few book to tax adjustments, but not so many to take account for the fact that financial accounting sometimes permanently differs from tax accounting. But basically, you would use financial accounting information to have a more streamlined approach, relying also on what those groups usually already have anyways to minimize their compliance burden because they need to do the financial accounting anyways, usually. And this is what you would use as a measure of profit. And then you would match it with the taxes that correspond to the profits per jurisdiction, which also means you need to know which profit goes to which jurisdiction. And basically that depends on which entity earned the profit and where this entity is resident, with permanent establishments being an entity in its own right for the purposes of this exercise. So you would assign the profits to a particular jurisdiction, profits calculated under financial accounting standards mainly, and then you would look which kind of taxes have been levied on these profits. And if it's too little compared to the minimum rate, you do an extra taxation. And then there's certain adjustments, especially to take into account loss carry forwards and so forth. I'm not going to go into the details. I also mentioned the carve-out for substance-based income. And basically what you would then do is collect the top-up tax if in a particular jurisdiction the effective tax level is too low. And this is, as I said, done either by way of sort of a CFC legislation in the ultimate parent jurisdiction, or it is done in a subsidiary fashion in the source country if the ultimate parent jurisdiction or the parent jurisdiction doesn't have an income inclusion rule. Well, while I don't want to go, for reasons of time, into the details, one thing is pretty clear, which is also a little bit shown by this slide as compared to, the next slide. Well, it's maybe a bit short, but to cut it short, the undertax payment rule is much more complex in handling than the income inclusion rule, which is basically due to the fact that the income inclusion rule would apply at the top. Only once, the ultimate parent would get to collect under a sort of CFC type rule the top-up tax that needs to be collected for all the subsidiaries in the group which are taxed too low by the minimum tax standard. Whereas if that doesn't occur and we go to the source countries, then the idea is that the extra tax should be collected from the entities that made payments to other group members, which enabled low taxed income. And of course, this is going to be a lot of entities potentially that made intragroup net payments, and you need to coordinate this. And there is a certain ordering rule within the undertax payment rule, which says which entity should get priority in being taxed under the undertax payment rule, and how to make sure that there is no double taxation, so it's well coordinated. But administratively, that means you'd need a lot of exchange of information internationally. You'd need a lot of administrative assistance internationally to make sure that it's really neatly aligned and we do not have over taxation. So each country applying minimum taxation to an extent that altogether leads to an additional tax way above the minimum rate, actually. So this is for both the businesses, but in particular for tax administrations, a more difficult exercise, which is also one of the reasons why the priority is with the income inclusion rule. Okay, there is some simplification methods being contemplated. They would, at the margins, they would reduce complexity, but they can't take away the inherent complexity that comes with the minimum tax regime. I mean, obviously, you need a lot of additional information. You need a lot of international cooperation to make this happen, and it's also a significant compliance burden for large businesses. And you can try to limit that, but you can't really take away the inherent complexity. So I won't go into the details here. How would that be implemented? Again, primarily, and first of all, you'd need a domestic law amendment. So you'd have to implement this extended CFC rule, the income inclusion rule. You'd have to implement some form of undertax payment rule. Then it would have to be assured that tax treaties are not in the way of doing this. Now, the OECD view is we can do it, most of it, especially the income inclusion rule, without having to change the treaties, which is a bold statement, and I don't want to go into details, but you could dispute this. But for some things, like especially the subject to tax rules, so the minimum withholding tax in the source country, you need treaty amendments to the extent that the current treaty does not allow for such withholding taxes. And so what the OECD again is considering, the inclusive framework is considering to have a multilateral instrument, a multilateral convention to make the necessary treaty amendment, just as it happened with BEPS 1, and to also make what would be a non-binding OECD G20 agreement, inclusive framework, political agreement, a public international law binding multilateral agreement. So this is the idea. What is disappointing is we find much less ideas about ensuring tax certainty, about international administrative cooperation than in Pillar 1. So here we have much less effort put into enhancing this. This is something the OECD and the inclusive framework pretty sure need to still work on. And finally, if this ever were to happen, the EU would probably implement GLOBE as an EU directive to make it binding for every member state to have. Now, a few final remarks. Again, first of all, we have, an extra approach for the US. The US has politically secured within the inclusive framework that it can continue to have its guilty regime, which is not fully aligned with the vision of a minimum tax that we find in Pillar 2. In particular, guilty is not applied per jurisdiction, but guilty is a sort of minimum tax that applies for global profits, global foreign profits of a group. So it allows much more netting and offsetting of low tax and a high tax in different jurisdictions than the GLOBE would, which is focused on individual jurisdictions. So it's not really a full equivalent. It's not consistent. It is fiscally relevant because around 30% of potential GLOBE revenue under a GLOBE would go to the US. So the US having a different regime makes an impact regarding, the revenue, but of course the effectiveness also of the minimum tax regime. But again, it's the US, and that was a red line for the US negotiators. So if that concession had not been made, we would not get any compromise on Pillar 2. And yeah, that's the way things are. Not everybody is equal, or maybe everybody is equal, but some are more than others. So it's a political compromise here. What is clear to me is that on the tax payment rule, given the need for massive international coordination of the minimum tax collection under an under-tax payment rule in the source country, coordinating this is nothing that could work on a broad scale. Remember, we're talking about 8,000 to 10,000 multinationals. If you need coordination amongst several source countries for those 8 to 10,000 multinationals with respect to the additional minimum tax to be levied, tax authorities are going to be overwhelmed. So the success of this really depends on an international agreement. We need a critical mass of countries that implement the income inclusion rule. If too many don't do it, and some might not want to do it because they want to become attractive as a holding location, claiming we don't have income inclusion rule, then it won't work. So this is why I'm also skeptical about this idea, which Germany floats, with the EU Commission floats, that if the OECD doesn't adopt an agreement, or if the inclusive framework, more correctly put, doesn't come to an agreement on a global international minimum tax, we're going to do a regional one. I'm not sure that's going to work. And yeah, I already said that negotiations are much more advanced on Pillar 2 than on Pillar 1. There is also the idea among some members of the inclusive framework, most notably the US, of course, to just have an agreement on Pillar 2 and then keep working on Pillar 1. That's not the way it's going to work. There's quite a few countries that don't like Pillar 2 so much, but would like to have Pillar 1, especially India and China. So you can't get Pillar 2 without Pillar 1. It's really going to be a package deal. So, you know, we're quite advanced with Pillar 2, but still we won't get political agreement at the international level unless we get political agreement on Pillar 1. Does it make sense at all? That's going to be the last question I'm going to ask, and then I think I'll finish. Does it make sense at all to have this, given that it is again a complex regime that adds considerably to the administrative burdens in tax authorities, but also, of course, to compliance burdens of the affected companies? Especially if we can see already that the minimum rate that will be agreed upon is not going to be above 13%. I can't imagine. So most, orient themselves, most discussions at the Irish rate, actually, which is 12.5% nominally. And this might be the minimum rate. It might be less. It might be a little bit more, but it's not going to be significantly more. Yeah, well, it might still be worth it if you look at, first of all, the revenues, because according to the, even though very rough OECD estimates, it's going to be 4 to 8 times the revenue than the countries would get under Pillar 1. So it's going to be a revenue raiser. Here we're talking about several tens of billions extra revenue for countries, in particular thanks to the subject to tax rule, also to some extent for emerging and developing countries. So this is something everybody should be interested in. Everybody, of course, than those who will, not benefit so much, which is the low tax jurisdictions. And on the complexity side, yes, it does add complexity. But on the other hand, countries could, having this as a broad anti-BEPS instrument, abolish or scale back some of their more targeted anti-BEPS instruments, such as interest deduction barriers, traditional CFC rules, and so forth. And finally, the counterfactual. What is if we don't get agreement at the OECD level? Well, then it is quite likely, as we observe in the Pillar 1 context, that also in the Pillar 2 context, minimum taxes, we will have an uncoordinated spreading of unilateral approaches, because the US, as I said, already has some form of minimum tax, guilty and beat, which is actually much more complicated and much less efficient than this globe would be. And if we don't get globe, quite a few countries might copy the US model, which is actually worse. Plus, it would be copied in an uncoordinated fashion, so a double taxation would be likely to occur. And given this alternative, an agreement of Pillar 2 might actually be the better choice. Okay, I think I've spoken enough, and this shall be it for my presentation, and I'm very happy to enter into discussion now.
Thank you very much, Professor English. And I have noticed you have made quite a complete presentation about the team in 1 hour, and maybe a little bit more than 1 hour. And I would say to resume around 500 pages in 1 hour is quite a huge challenge. And then I remember back at that time, 2009 in Augsburg, when I have said to you, I had a lot of doubts about my PhD thesis, né? And you told me, hey, Gustavo, calm down, just sit down on your chair and read as much as you can. And then I remember at that time, I have read your whole habilitation thesis, Wettbewerbsgleichheit im grenzüberschreitenden Handel. I think I was the only one to read your complete habilitation thesis, I must confess. And then, but I have never forgotten that I just needed to sit down on my chair, back down at the library, and read as much as I could. Yeah. And then after that, 2017, when we were for the last time together in São Paulo. If you remember that time in São Paulo, 2017.
We had a very nice beer. I still do remember
I think
that.
we were at that time. Yeah, that's true. That's true. We have a really nice beer. Yeah. And you were that time in some event at the USP, Universidade de São Paulo. Yeah. And as we were heading back to the hotels, I have asked you about this new international scenario for tax planning. I still remember that was one of my questions that I made to you about the tax planning. And then I have asked you, what about the new international trends on the field of tax planning? And I still remember that time you told me, wow, I think tax planning may be coming to an end. Yeah. And my first question, Professor English, would be related to these new international trends in tax planning. Do you still think, regarding all these, at least 500 pages and all this discussion at the OECD Forum, that the tax planning, or at least the international tax planning regarding intangibles, had really come to an end, or is there still place for do some kind of tax planning? That would be my first question.
Okay, thank you very much, Professor Fossati, for this question. First of all, I think it's important to underline that BEPS 1, so what we got 2015 as the outcome of the first BEPS round, has certainly not ended tax planning opportunities, contrary to what some claim. So there is some opposition, in particular against the minimum tax, against GLOBE, because some claim that we should wait for the BEPS 1 outcome. Maybe there is no BEPS anymore, so we don't need a minimum tax. And of course, this is, interest driven. It's national interest of those low tax jurisdictions. I can understand them making those claims, but it's definitely not a well-founded claim. This is also supported, for example, by analysis of the IMF, which clearly show that under the BEPS rules, profit shifting is going to be a bit more costly, a bit more difficult, but it's certainly going to go on. Why so? Basically, because it's inherent in the systems and the basic principles and rules of the international tax system as it was conceived 100 years ago, and which has not fundamentally been changed on the BEPS 1. We still have transfer pricing. We still have allocation of profits mainly based on risks assumed and assets used plus functions performed in relation to those assets. Now, the functions performed aspect has been strengthened a little bit, so it's not enough that you just put an IP in a location. You have to have a few people doing these so-called DEMP functions, development, enhancement, and so forth. But, instead of 0 people, maybe now it's going to be 5 people. It's a bit more costly, but yes, a global multinational can put 5 people into Ireland or whatever, and then it's okay, and it still can do the profit shifting based on intangibles. Or it can still allocate risk. Now, the OECD in Actions 8 to 10 of the BEPS says, yeah, but risk allocation alone is not enough. People must be able to manage the risk, and there must be some dotation of capital to actually be underlying the risk. Okay, you put in some capital that might be costing you a little bit. You put in a few people managing it. It's going to be a bit more costly, but you can still do it, and then you still can do this kind of profit shifting. So definitely these kind of profit shifting techniques continue after BEPS 1, and so do others, such as, for example, basically converting equity into loans, even though there is now some limits on this. There's only outer limits. So there's a lot of opportunity out there still. Would it disappear? Now, this is what your question basically, as I understood it, if we implemented Pillar 1 and Pillar 2. No, it would not fully disappear, but it would be reduced. First, the minimum tax is not about abolishing tax competition. I mean, if we were aiming at that, we would need a rate of 30%. This is not going to happen. It's politically unfeasible. We would never get a compromise on this. Too many countries would object. But if we had a ceiling of 12.5% effective tax rate, a lot of profit shifting into tax havens would become unattractive. A lot of using patent boxes, which are still around under BEPS 1, Action 5, would become unattractive. Why would you go, to an Irish patent box offering you 6.25% tax rate if, there's a minimum tax lifting it up again to the 12.5%? So the patent box becomes unattractive, essentially. And so it wouldn't disappear because you could still compete via taxation above the minimum rate. And of course, countries like, say, Germany or Sweden or other high tax countries, maybe also Brazil to some extent, wouldn't go down to 12.5% anytime soon, maybe never, and others still would. So there would be some competition, and therefore also there would be possibility for tax arbitrage still, but it would be limited. There would be a lower ceiling, a lower floor, lower floor to this. And when it comes to Pillar 1, it just takes away some of the profit that is susceptible to tax, to profit shifting, because some of the profit, the amount A, couldn't be shifted anymore by reallocating IP, by reallocating risk, by reallocating people. No, it would just be taxed where the market is. And it's not so easy to shift your market, right? Because consumers are where they are, and people are not going to move to Luxembourg so that Amazon can pay lesser tax, right? So this is not going to happen so easily. And so some of the profit would be taken out of this international tax competition, tax shifting game. Now, not so much, as I've said, only a certain percentage of excess profits, not very much at the beginning. But, you have to look ahead maybe 10, 15, 20 years. If that step were taken on an internationally agreed basis, it wouldn't stay like this. The great trend also in academia, which has strongly endorsed, at least large parts of it, the concept of either a fully pure destination-based cash flow tax, or something that comes close, taxing at least excess profit destination, or the idea of many NGOs close to the developing and emerging countries to have an allocation formula based on assets, payroll and sales. That the international trend is to go more towards taxation as destination, not only in the sphere of VAT, GST, but also in the sphere of direct taxation. And so this would be a first step in that direction. I'm pretty sure if this first step were taken, it wouldn't be the last. And so since taxation at the market is less prone to profit shifting, even though it's still possible in some extent to do some planning, but much less, yes, we would see less tax planning. We would see more stable and higher tax revenues, but there would be still room for some planning left, eventually.
Thank you. Thank you very much, Professor English. And you have made a completely approach about income and revenue in your presentation, And I would like to ask you maybe some questions regarding now consumption taxation. And because we are discussing the last 2 or 3 years here in Brazil, our tax reform, and it seems like, as far as you can notice on the media as well here and on the background here from the political discussion, that the first phase of our tax reform here in Brazil might be the consumption tax reform. And afterwards, it would be the income revenue tax reform. And on the grounds of consumption taxation, as far as I have correctly read and comprehend in the OECD VAT GST guidelines, okay, it's quite, I would say, an old document when we compare with the last OECD documents regarding BEPS, okay? So it's the old VAT DST guidelines. So as far as I have correctly comprehend, OECD understands that VAT, the VAT model, the VAT legal design, the European design, would be still able to cover all these issues or tax challenges arising from digitalization in consumption taxation. But we have noticed as well in parallel that many countries had adopted unilateral measures regarding DST. And then, Professor English, my second question would be, is there a space of a possible coexistence between VAT and DST? Also, when we consider that these countries, which had already implemented these unilateral measures regarding DST, they might need this revenue from DST for the next years. As you said, when we consider COVID-19 time and crisis, yeah. So is there a space for coexistence between VAT and DST in consumption taxations? That would be my question.
Yeah, well, thank you. That's many questions. I'll try to answer to the extent that I can. Well, when it comes to the reform of the Brazilian system of consumption taxation, I think it's probably evident to everybody in Brazil and to a lot of people outside Brazil that this is overdue. And as far as I'm aware, that the main problem is the different allocation of taxing rights at the different levels of government in federal Brazil, right? And somehow this Gordian knot has to be, just cut because you have a system that is uncoordinated as far as I can see, and as far as I know from my research. I've been to Brazil almost every year until a couple of years ago, and that produces a lot of economic double burdens of cumulative tax burdens.
Cumulative.
I really struggle to phrase it in the Portuguese way. I'm sorry. Cumulatividade, right? Yeah, effectively, even though you have a principle of non-cumulatividade, and it's basically not a very consistent system, and it's Byzantine as the Indian was. Now the Indian have reformed theirs, so Brazil is really the big country globally that would need a systematic tax reform in consumption taxes still. So I can only support this initiative, and I know it's politically very difficult, as is always the case when different levels of government in a federal system are involved. And I just hope, the political capital of your president will still be enough in Congress to somehow get a reform through that is acceptable to all levels of government. I'll put it this way, and I don't want to get any more into this. When it comes to VAT on digital economy, digital services, indeed, we have VAT GST guidelines published, I think, already many years ago. Yeah, I should also mention that I am a member of an academic advisor member of the actual wording party and technical advisory group, working on this since 10 years. So I have some insight into these developments, and clearly the intention of the members there, and it's not only OECD members, there's also associate members involved, and the OECD reaches out through global fora towards non-members. The intention here globally is to tax more on the VAT of what we see in terms of digital services at destination, so where the users are of those services. And we have not only a concept for how to do this from the perspective of substantive tax law, basically determining where destination should be. So we need proxies to determine whether a certain service has been consumed, well, in Brazil or in Argentina or in Peru or whatever, but also how to do it, which is of course the most important question, how to do it technically, how to actually collect the VAT. There's a lot of effort been put in this, so we have now a mechanism that should enhance and facilitate voluntary compliance, which is what it still basically rests on. But there's also best practices on how countries can give a little nudge, to those large companies to actually comply by monitoring what kind of companies are active in a particular jurisdiction, for example, and then sending out letters like Australia did. They send out like thousands of letters to all companies with a significant presence in Australia, digital presence, and say, look, we have new rules. You should now pay tax. Would you please, not forget about that when you submit your next tax return? And they were quite successful with this. So there's a lot to learn from this, and there is a lot of documentation at the OECD going beyond the VAT GST guidelines that offers this best practice experience. Plus, there is a more recent initiative that has led to 100 and something pages of recommendations how to tax the platform economy more broadly. So also to the extent that we have delivery of goods, not just services, via online platforms. And there is several workable measures how to implement taxation of this sector of the economy better at destination, so that the market country gets to collect more VAT. And finally, the OECD is currently working on a blueprint, if you like, a recommendation for the sharing economy, which is going to be published for sure in 2021, so next year. And you will find recommendations for this important sector of the economy as well. What is still outstanding, but will also be worked on, is a better international framework for administrative assistance. The entire international framework of administrative assistance is currently too much focused on direct taxes. We need more in terms of indirect taxes. Here, actually, the European Union is quite a pioneer in this regard in recent years. So this is some experience that will certainly feed into the OECD discussions and be one of the best practices maybe that will then be made available to all countries. So I think this is a huge source of revenue, much more actually than you can gain in the short term from direct taxes on these companies. And it's also internationally much more accepted that, yes, this should be taxed at source. So indeed, I would say, if you have to make a choice, devote more resources to this, devote more resources to making this work in your country, VAT on digitalized services and the platform economy in a broader sense. Now, is then there still room for DST? In my view, yes. I mean, I would clearly consider DST inferior to an internationally coordinated solution because it's taxed on a gross basis. So, for loss-making companies, and there's a few like Twitter that do make losses. It's a heavy burden. It is also not, well, per se coordinated international, so it can employ some double taxation and so forth. But if you don't get anything relevant at the international scene, and you do need revenues, then it's sort of a kind of withholding tax substitute for those profits that are realized in the market without a physical or a relevant physical presence. And I think, even though it is taxed on a gross basis, conceptually, most countries would consider it to be a tax on the company and not a tax on the consumer. So it's not really conceived as an indirect tax. Of course, we all know that market forces might lead to a result, as with any tax, that implies that the tax incidence is with the consumers. But the conception, the idea is that the tax burden should be with the company. So it's not, as I perceive it, in direct competition with the VAT. It's not a VAT replacement. It's a replacement of a direct tax that would be levied on the profits of those highly digitalized businesses in the market jurisdictions, which we don't have at the moment internationally agreed. And last word, the fact that it's levied on a gross basis might, for many companies, not for all, but for many highly digitalized companies in the services sector in particular, not be such a heavy burden, because there's not so much difference in their business model between gross and net, because the marginal cost, of having an additional, online advertisement displayed to another consumer is close to zero. That's scale without mass. This is the business model of the digitalized economy. And so there's not much marginal cost for those services. And so, if you tax on a gross basis, it's not usually overtaxation so much as compared to taxing on a profits or net basis. So I think it's quite an acceptable add-on as a maybe second or even third best solution, as long as you don't get the first or second best solution.
Okay. Thank you, Professor English. We have an actual concern in the last 2 years regarding our consumption tax reform, and in one of our tax reform proposals, there is a disposal in which the responsibility for the tax collection and for tax accessory obligations, they fell upon the digital platforms. But in our case, at least in this proposal, this is the federal government proposal, all this compliance burden, all this tax responsibility fell upon the digital platforms. And what is the problem here in Brazil? When we take a look at our context here, if we see, for example, the last report from the Doing Business, from the World Bank, Brazil's position in this report is something like 180, 184 in this ranking of doing business. That means it's not a good place for doing business in Brazil. That's the truth. And second, there was a report early this year from Deloitte, and assessing the compliance burden of our companies here in Brazil, and also relating to the hours which are spent for this tax compliance. And we have maybe over 3,000 hours per year regarding tax compliance in Brazil. And I think this is a real concern here in Brazil, We have already this huge compliance burden, and then our federal government came with this proposal to set all the tax responsibility upon the digital platforms. I can understand that on the grounds of efficiency, on the grounds of simplification, okay, that would be maybe the best scenario to drive this responsibility upon the digital platforms, okay. But regarding our context here, if we see this Doing Business report, for example, from the World Bank, and this report from Deloitte, would that be the case for Brazil?
Well, I think the answer to this is probably not entirely a uniform one. It depends, I think, on the business model. So I think two scenarios need to be distinguished. One could be that you add compliance burdens on the platform, but you take away at the same time compliance burdens on the underlying sellers, the underlying suppliers using the platform. And this would be the case, as far as I can see from the discussions also at the OECD, especially with the sharing economy, because here the idea is basically that you want to make those that offer their services via platforms, be it a transportation platform like Uber or BlaBlaCar or others, or an accommodation platform, Airbnb and so forth, or say another platform such as well, a delivery thing like whatever. You want to make these people who generate small, typically, income, nevertheless, to pay some tax on this, maybe some VAT, depending. And for them, it's a huge burden because they're small. And as we all know, compliance burdens are regressive, meaning the larger you are in terms of profits and revenue, the less you will be burdened per real of revenue or profit by a compliance burden. And so if you take away the compliance burdens from the small ones, because they are transferred to the platform, and the platform has to do the compliance for all these underlying people using the platform, and they are relieved from this, then you will have an overall gain. And this could actually be a boost, both in terms of revenue, because as we all know, those small ones, not only is it a higher burden for them to comply, but quite often they're not compliant precisely because it is a higher burden. And for the platform, it might then be a burden as well, but they might slightly raise the prices or give maybe their provisions for, say, the Uber driver. They would receive a little bit less, but the Uber driver would receive much less in terms of income from driving than would be his compliance costs if he himself or she himself had to comply. So I think in this case, it would really be a win-win situation. Platforms would probably shift down the additional costs in prices or in revenues of the underlying suppliers, but the difference would be much smaller than the compliance costs if every small supplier had to supply. And you would get more revenue because tax honesty would improve. And then there is the other scenario, especially when we talk about large marketplaces or just online presences like Amazon, where this is not working out like this because you're just adding additional compliance costs, you're not taking away from anybody. Here it's more difficult, and of course, if you already have a bad record, you probably shouldn't make it worse. I agree. And one of the insights I really took from the discussions the last 10, 12 years at the OECD, because in the technical advisory group on consumption taxes, we have the specific situations, it's unique in the OECD, that business is around the table. So we have not only government representatives, but half of the delegates are business representatives. Not at the decision-making level, there it's governments, of course, but at the technical discussion level. And one of the things I really learned is rely on the information that's already there. So I think it makes a lot of sense to rely on the wealth of information that platforms have for tax collection purposes. But if you want to keep the extra burden for them as low as possible and still gain a lot in terms of control instruments for the tax administration, well, then make them supply information only that they already have according to their business model, so that they don't need to set up extra routines, but rather, they can just tap into the database that they have anyways and provide the information. And of course, it needs to be done electronically. But I think when it comes to the digitalization of the tax administration, Brazil is actually doing quite well. It's not really number 184 in this regard. So I think this is something to build on. You have a tax administration that is already quite well digitalized, giving the overall state of the economy, and build on that and make the platforms transfer the information that they can easily transfer, and then it shouldn't be so much of an extra burden.
Very good. I think that would be a good idea, Professor English. And we have a question here, Professor English, from a colleague of mine, of ours here at the FGV Fundação. Is from Professor Melina Rocha. Melina Rocha is living in Canada, in Toronto, for I think the last 2.5 years, but she's still a colleague and maybe a so-called partner of us here. And I think Professor Melina here, she always make some really good questions here. And if I could read here some appointments from Professor Melina, she wrote here that the European Commission held as early as 1997 that online supplies should be treated as services for VAT purposes. However, this is not an approach followed by all countries. In Canada, for example, a transaction with intangibles is not treated as a service for VAT purposes. And then Professor English, Melina asks you, as we are discussing the design of the VAT in Brazilian tax reform, what are the pros and cons or contras of the EU approach for taxing online supplies as services?
Okay. Well, thank you for the question, dear colleague. I think it is not really essential how you name the child. It's essential how you treat it, as with real children, maybe. So, you know, what we really know is rules both on the substantive side, so where taxing rights should arise, using proxies for real consumption, and collection mechanisms that work. And whether you designate the supply as a service or whether you designate it as something in its own right, a supply of an intangible digital item, whatever, I think does not matter so much unless I miss something important. But to me, the real question is, what kind of place of taxation rules do you have? So are they liable to allow taxation at the place where the user or consumer really is or is likely to be when the service or the supply is delivered, and then offer tax collection mechanisms that make it easy to comply and that are, to the extent possible, susceptible to control by the tax administration. And I mean, the only aspect that is sometimes mentioned, or discussed, is that, you know, it's good to have as few distinctions as possible in general, so as to avoid marginal cases and uncertainty at the margins, so that you have more disputes when it comes to classifying something as a service or as something else. But since you would probably need extra rules for those digital supplies anyways, no matter how you classify them, you have those marginal issues arising anyway. So I'm sorry if I maybe don't satisfactorily answer the question, but to me, it's not so essential whether you say it's a service or something else, as long as you come up with reasonable place of taxation rules and reasonable collection mechanisms.
Okay, thank you, Professor English. And I think I can understand the question from Professor Melina, Professor English. As you might remember at that time in Augsburg and in Münster, when we discussed or when we compared the German VAT with our three consumption taxes here in Brazil, as you remember, the ICMS, ISS, and IPI, and we still have this this division of competence rules in our constitution, and so and we also have strict concepts of selling, supplying, services, and also industrialization, and for each of these strict concepts, we have a specific tax competence rule. One of them regarding the federation, the other regarding the states, the Länder, and the other the municipalities. And we still have the so-called fiscal war between the federation entities. And Of course, you don't have this problem in Germany since you have implemented the VAT in the European model, as you have designed the VAT as a tax on revenues. Ja, die Umsatzsteuer, ja, fällt auf Umsatz, ja, is upon revenues regarding supplies, services, and intangibles as well, if you can see. So you don't have this discussion in Germany. If there is a service, if there is a industrialized project or some kind of merchandise of supply, yeah.
Yeah, so I know I get this background, and of course, if in a federal system, as in Brazil, you don't just share the VAT revenue as is now practiced in India, but rather you have different revenue entitlements depending on category of supply. Yeah, then of course it makes a big difference. We don't have that in Germany. To my knowledge, we have that nowhere in Europe, even though Germany is not the only country with a federal constitution. But of course you have it. Yeah, and in this case, my question would be, well, what category of supplies do the digital ones substitute? And there you might need some economic analysis. And if you find that mostly what is now a digitalized supply, an online supply, used to be a service that was performed physically, then you probably should designate it a service so as to compensate for the loss of revenues for the traditional services. Whereas if you find, that's not necessarily the case, now a lot is digitalized service, what used to be a physical supply, if that were the conclusion, which I doubt, but could be, or some category that received special treatment, yeah, then it should be probably classified accordingly to make up for the revenue loss in the traditional economy.
Yeah, okay, I can understand. For example, if you contract here today from Microsoft, the Office package, but as a software as a service.
Yeah.
That means in cloud computing. That means we don't do anymore the download of a license of the program.
Right.
We don't buy as well. We don't receive any kind of a physical supply of this software. You know that, yeah. And then we have this challenge now in front of us. What is the tax competence rule here in this kind of intangibles? Yeah, is that a competence rule from the federation, from the states, from the municipalities? Yeah, and nowadays both federal entities are charging taxes upon this kind of services or intangibles. The states are charging with ICMS, the municipalities are charging with ISS. Yeah, and then and we are trying to solve this problem with a complete broad-based VAT. But I'm not sure if we can reach this position. Professor English, we still have 7 minutes here. I would like to give you, maybe the opportunity for your final considerations, since we don't have any further questions here from the audience, but I'm sure the audience would like to hear from you, from your final considerations regarding your presentation and the questions here as well.
Well, I mean, wow, yeah, to sum up those almost 2 hours, that's a challenge. I mean, I think what might be interesting, I would have also, like to know the views of you and others maybe on how Brazil should position itself vis-a-vis those international developments. So my idea is, and maybe these are my then final words, that even from a country that is in transition to being a highly industrialized, high-income country, but still an emerging middle-income country, such as Brazil, I think it could be reasonable to support the ongoing OECD negotiations, to be proactive and supportive, basically regarding Pillar 1, because it is a step in a direction that is, in the long run, going to benefit countries such as Brazil, both from a revenue perspective, which currently would not much, but also from the perspective of moving away from the arm's length principle in areas where it's too complex or doesn't really work anymore, taking also into account capacity constraints. Now, Amount A is also very complex, but if you do that on a broader basis, complexity should be reduced, revenues should rise because there's less room for planning. And also because in addition, you get Pillar 1 as part of the package, which I think is also attractive revenue-wise, further reduces planning. However, having said this, I think a country such as Brazil probably can't be content with just that, but you have to, in parallel, come up with your own additional solutions. And in my view, that would be, to the extent possible, push for further source taxes, ideally in a coordinated way. So the DST, is a solution, but it will be very hard to align this with the overall framework. And so it is, in my view, something that is acceptable if there is the revenue need, but it's definitely not ideal. And I would say preferably expand VAT and expand classical withholding taxes as you find them in the UN model. On technical services, maybe to some extent that has not been picked up much. Maybe the new 12B supporting something like it, DST, but in an internationally coordinated fashion, that could be a good approach. And also relying on the services PE, which you find in the UN model, different from the OECD model, and which also gives additional revenue to source. So really be a bit as a tax policy approach, rely a lot on those classical source withholding taxes plus on VT to the extent possible in an internationally coordinated fashion, and to the extent not, then it's a trade-off, and you might want to opt for something that is unilateral. But that would be my suggestion. So not to discard the OECD process as something that's not gonna benefit much, because you have to also view it in a long-term conceptual perspective, and then I think it becomes much more attractive.
Very good, Professor English. My friend Joachim, vielen Dank vom ganzen Herzen. Es war eine echte Vergnügen, hier zu sein mit Ihnen. And I hope we can see each other very soon. I'm sure that the audience, at least my graduate students, had loved your presentation, and I'm anxious about hearing the comments from them about your topics here. And from the audience here, and for the audience, we have spoken here today with Professor English, and I would say one of the VAT experts, international VAT experts in the world, one of the best ones that is studying and facing VAT challenges around the world for the last maybe 20 years, I would say, and is working also close to the OECD. And I'm sure Professor English, my friend Joachim, can be much more closer to us from the next year. And I hope he can join us here physically as well after this crisis, and come to us to Rio de Janeiro and join us in our further discussions here. Professor English, once again, my friend Joachim, thank you very much for your time, for your presentation. As I said, I think you have made a magnificent summary of these 500 pages from the OECD in a short time. And I'm sure that the audience in Brazil will take a look and see your presentation at the YouTube channel from the Fundação. Okay, it will be recorded and left there at the YouTube channel from the OECD. And I'm sure we'll have also some further comments about your presentation. Anyway, we keep in touch. I hope you see each other again. And alles Gute noch einmal. Vielen Dank. Und ich hoffe, wir sehen uns in 2021. Hoffe ich. Ja, hoffe ich.
Ich hoffe es auch.
Entweder in Düsseldorf oder in Münster, ich weiß es nicht, aber mal sehen.
Also vielen lieben Dank, Gustavo. And I'm sure we'll meet again, and I very much hope in Brazil, in Rio, and I very much hope next year, and certainly would be one of the top places to go for me if traveling becomes possible again. So yes, I always felt, so welcome, and intellectual exchange is so interesting with you and others in Brazil that definitely I would love to come again.
Thank you very much, Professor English. E obrigado mais uma vez agora em português a toda a audiência, aos queridos alunos, alunas, aos colegas, Brasil afora, e a gente dá por encerrado então essa sexta rodada ou fase de seminários em torno da regulação tributária da economia digital na reforma tributária. E, mais uma vez, muito obrigado também por toda a equipe de apoio aqui da Fundação Getúlio Vargas, em especial hoje a Letícia, e novamente a Kika e o Emanuel Paraíso, que têm trabalhado constantemente, incansavelmente, no suporte técnico e operacional aqui de todos os seminários. Muito obrigado e até uma próxima.